Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're delving into the 2025 edition of the UBS Global Family Office Report. This sixth iteration reflects the views of more than 300 family offices, managing an average of $1.1 billion. At a time of increased volatility, global recession fears and following an almost unprecedented market sell-off in early April, this latest edition serves as a good reminder that family offices around the world are, first and foremost, pursuing a steady long-term approach as they focus on preserving wealth across generations. Even with the survey largely conducted in the first quarter, family offices were already acutely aware of the challenges posed by a global trade war, identifying it as the year's greatest risk. Yet, in interviews conducted following the market turmoil that erupted in early April, they reiterated their diversified, all-weather strategic asset allocation. To explain more about all of that, and to guide us through the other changes from last year's edition, to highlight the depth of regional analysis in the report, and to offer a glimpse into what family offices worldwide are expecting next, it's a great pleasure to welcome back to the show Maximilian Kunkel, CIO for Global Family and Institutional Wealth at UBS Global Wealth Management. Monocle's Chris Chermak was asking the questions this week, and Chris began by asking Max about the mission of the GFO report each year.
It is, and the idea behind this is really to get an insight into what some of the largest and most sophisticated investors in this space are doing and planning on doing, not only when it comes to matters regarding investment, asset allocation, and the like, but also beyond that and more closely linked to areas that are more operational when it comes to the family office themselves.
Give us some idea of the methodology as well. How do you actually go about this? You're conducting in-depth interviews with a huge number of family offices.
Sure. So, for example, this year's report reflects the views of 317 single family offices from across 7 regions, representing families with an average net worth of $2.7 billion. It is conducted via survey, which runs for a few weeks, as well as individual interviews with some of the family offices themselves.
And we will get to the details, obviously, but give us an example of some of the questions that you ask.
We would typically ask them about strategic asset allocation. So what is the long-term mix between different asset classes that family offices in different regions have? We would ask them about preferences with regards to, for example, themes. We would ask them about the risks that they see both in the near and medium term and how they go on about facing those risks. But equally, we also ask them about some of the more operational matters and longer term issues that are concerning the family office and the family itself. Think about succession planning, for example, as well as staffing.
And family offices are obviously a somewhat unique aspect of the banking world. Tell us, you did mention risks there, and we're going to get into that. But tell us more generally, with the sort of long-term outlook that family offices obviously have, how sensitive or reactive are they actually to things like geopolitical volatility and all that?
So we always have to bear in mind, and you hinted at it, that family offices have certain advantages. They have access to patient capital, so they can have a long-term focus. They typically don't have the same kind of liquidity requirements that some other institutional investors may have. And equally, they are not told by some regulator where to invest and how much to invest in which asset class. So that in turn gives them quite some flexibility. And that in turn has also meant that they themselves can afford to have a long-term view. And whilst they're not blind to risks that are on the horizon, both in the short and in the medium term, what we tend to find is that they have a very disciplined approach towards investing and following their longer term strategy, and therefore also are able to go through short-term noise in markets in a fairly disciplined manner.
A disciplined approach would suggest, I suppose, that when it does come to risks, they're taking a long-term view. They're looking at long-term shifts in the geopolitical space. And it would probably be fair to say we've seen a little bit of that this year already. So bringing us to the survey, I do understand it was done in the first quarter of the year. So not everything that has happened, particularly the tariff announcements, are directly factored into this, but what kind of impact has the geopolitical situation had on family offices?
Well, first of all, it means that family offices continue to diversify. I think this is an important aspect, but let me maybe take a step back and think a little bit about the risks that they've seen both for this year and then beyond, and also how to approach them. So for this year, it was well flagged. 70% of family offices thought that the top risk for this year would be a global trade war. And of course, now the question for many is really what comes after that. And here, over the course of the next 5 years, the big risks for family offices are what you just indicated: geopolitics, a potential recession, a global scale, or even a debt crisis. Now, what's interesting, we just talked about this long-term mindset, is that family offices, they're not blind to these risks, but they do prepare for them. When I say that, it means that they do not retreat from risk assets because they see those risks are on the horizon. In fact, actually, 89% of family offices that we surveyed say that over the course of the next 5 years, they want to keep or even increase their allocation to developed market equities. So rather than retreating from markets, what they do is they focus on diversifying portfolios sufficiently to be able to capture opportunities, but at the same time, be prepared for some of the risks that may come along. And the diversification these days, which is of course a big question for many, how do I achieve a diversification, is often achieved by 3 things really. The first one is a greater focus on active management, manager selection, more interest in hedge funds, and lastly, also an increase in popularity when it comes to precious metals.
And we can go into some of those, but to get back to the trade war risk in particular, I'm just curious, again, from this perspective that family offices have looking at the long term, presumably it's less perhaps about an active trade war, if you will, that will end at some point in the shorter or medium term, and more about, say, an entire reordering of global trade. How do they look at that?
They do look at it, and I think here there's really 3 things that they focus on. They continue to focus on having a strategy in place, and that strategy ultimately seeks to focus on 3 things that in part are also driven by everything that we have. First of all, amongst all of this noise that we have there, and of course some of the shifts that we have, you want to continue to focus on the structural, longer-term growth themes where fundamentals, even despite the trade developments, are clearly still in place. And that is namely AI, electrification, as well as areas of healthcare, such as longevity. Now, the second one is, amidst all of this, there's a clear understanding that policy rates, for either reasons of slower growth in the United States or also disinflationary developments outside of the United States, are likely going to come down over the course of the next few months and quarters. And that in turn means that family offices are seeking to enhance and make more durable the yield that they get on portfolios. So here there continues to be some focus on developed market fixed income, but also quite noteworthy an increase that you're seeing in private debt allocations. And the last part is really, amongst all of this uncertainty that is created also by policy developments, a focus on sensible diversification. And that diversification is across asset classes, but it is also across different regions. And there's often this question around, is everybody over-allocating to the United States? Well, bear in mind that the story of US exceptionalism, at least when we look at the survey findings, is something that is very peculiar to the United States family offices. So here, the big home bias is something that we see here, 86% of assets allocated to North America. But outside of that, family offices are a lot more diversified and don't have that overexposure to the United States.
Tell us more about that aspect of this report, because I understand it's somewhat new given the fact that you had so many family offices involved in this 317, as you say. You really did go into these regional differences in approach. And as you say, expand a bit more on kind of this impact, particularly of U.S. family offices that are pivoting away from international markets.
Sure. So what we've always had is that US family offices have had a strong focus on the United States. And that's understandable ultimately, because you had very attractive opportunities both in public and private markets, relatively elevated yields also. But recently it's even gone higher than what we had seen in previous years. And I mentioned just the 86%, for example, that family offices say that their portfolios are allocated towards the United States. Now, when you're looking at the exposure there, it is principally more focused on riskier growth-oriented assets. So I think public as well as private equity. When you're looking at other family offices, what you find is that I would say European family offices tend to focus more on longer-term stability and growth over the long run, and have amongst the most diversified approaches, both when it comes to regional allocations. They have a tad more than 40% allocated, for example, to the United States, as well as to Europe, and the rest then to the rest of the world. But also when it comes to allocations in different asset classes, where it's very broadly diversified. When you're looking at Latin American family offices, for example, they tend to focus a lot more on stability amidst a lot of volatility on the macroeconomic and regulatory side that they often face themselves in their home countries. They really have the highest allocation when it comes to developed market fixed income, more than 30%, for example. Lastly, when I think about, for example, Asian family offices, there is a lot of focus on growth and particularly technology, also in the broader region. Now, looking ahead, what is it that we find? We find that family offices are still seeing opportunity in the United States, and there's still a willingness to add to allocations in the United States. But importantly, we also see that family offices are increasingly finding opportunities coming up outside of the United States because of positioning, policy development, and profit developments all moving into the right direction. So Asian family offices have a greater interest in increasing allocations to Asia. By the way, the Middle East is also quite interested in Asian assets. Europe is seeing an increase also, both in interest in Europe as well as in Asia. Americans increasingly see an opportunity in Western Europe occur. So you're starting to see, I think, both still a focus on the exceptional opportunities that you have at the United States at an individual company level and thematic level, but equally with some of the developments we've had of late, greater interest also in the opportunities that arise in other regions.
And Max, you have touched on this already, but tell us a bit more about this shift towards developed market equities that you were talking about, this search for structured growth opportunities. What does that look like?
Yeah, what we've had over the course of the last few years was actually a fairly consistent development in that cash holdings have been coming down, and at the same time, allocations towards riskier assets, equities namely, have gone up. And at a global average level, this has mainly benefited developed market equities, where allocations are around 30% on average at the moment. And this is principally because many family offices have seen greater opportunity in accessing structural growth opportunities, not just via private markets, but equally also via public markets. Think in particular about AI. What I would say, though, is that the clear feedback from family offices continues to be that they look at it not so much as a private equity versus public equity, but rather at an equity exposure level. And for them, what is important is to see how can I best create a complementary portfolio of equity allocations across both private and public equities. So here, the view when it comes to private equity becomes somewhat more discerning. And of course, a greater focus also on diversification on top of what one already has in the public equity space.
So private, public equity, perhaps not a difference, but also within sectors. Can you tell us about how family offices approach that? What do they look for? Or do they have an approach that differs, say, within the healthcare space, emerging technologies, AI that you mentioned as well?
Yeah. So generally, one of the things that you find, and this also, helps getting through some of the short-term drawdowns that you often have in public markets, is really a focus next to diversification and a clear strategy on quality. I mean, that doesn't mean that you're not going to see any drawdowns in your portfolio, but of course it protects you from a permanent loss. And therefore, what you also tend to find is a focus on quality within structural growth themes. And the themes here where the most focus is very much on AI. It is on areas such as longevity within healthcare, as well as what we call power and resources, or really anything from the generation of electricity towards the storage, distribution, and usage of electricity. And here the opportunity set is quite broad, with a lot of quality companies well established already within the AI space, in public markets accessible. And when it comes to, for example, electrification, there's also plenty of quality opportunities there on the public market side, but also, and we clearly hear this from our European clients, a lot of opportunity in innovative companies still coming about in private markets. And this also explains in part why, for example, European family offices this year have seen quite a significant increase once again in private equity allocations from 22% last year to 27% this year, because they see within this theme a big opportunity occurring in private equity. And when it comes to healthcare, it very much is a mix of, on the one hand, having access to innovative companies, which are largely accessed through high quality, well-established managers, as well as, of course, individual securities at a public market level.
And Max, to kind of sum up how family offices are feeling at the moment, how optimistic are they about the future? Are they optimistic about the future?
I would tend to say they're optimistic about the future, but of course they do see the need for diversification, given some of the policy uncertainties that we have, and also economic uncertainties. I think what these kind of environments always show, once again, is that this long-term mindset of many family offices helps a lot to go through these periods of uncertainty, because it means that you always go back to what is it that I ultimately want to achieve, and what are the key features of my portfolio. And as I mentioned earlier, on the key features of the portfolio are increasingly, the structural growth themes, access through a variety of different asset classes and regions, the enhancing of yield, and the diversification through manager selection, hedge funds, active management, as well as also increasingly precious metals. And having this approach is something that family offices makes them feel more comfortable with the current uncertainties, and that they can look through these uncertainties.
Now, Max, I did want to touch on some other aspects of this report, because of the fact that you also go into the mechanics of running a successful family office. Tell us about some of those aspects. How do family offices decide what to do themselves, what to outsource, some of the strategic considerations when it comes to that kind of decision-making?
Deciding which functions to perform in-house is quite crucial for family offices. They're typically lean, and as such, they base this decision on expertise, privacy needs, and maintaining operational control. Somewhat surprising, cost effectiveness is important, but it's less of a priority. And when they make new hires, this might be somewhat different maybe to bigger companies, family offices put trust and personality before education or qualifications. When we talk about some of these issues, I think one thing that is very, very important, we talked about risks earlier on, but principally related to investment risks. One shouldn't really forget about one big risk, which is, do you have a succession plan in place? And what we found out here is that just over half of the family offices surveyed have a succession plan in place. Many beneficial owners just do not see it as a priority, and that could lead to challenges in the future. But then we ask, but why is this? And many beneficial owners appears they feel that they have plenty of time or just don't see it as that urgent. I think this is something that where family office can still work on.
That was Maximilian Kunkel. Big thanks to him and, of course, to Chris Chermak, who was asking the questions this week. And that brings us to the end of this edition of the show here on Monocle Radio. You can listen again and explore more at monocle.com. Follow us wherever you get your podcasts and discover more and find out how UBS can help you at ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.